welcome to our next Meet the Investor episode. We are delighted to have joining us today from their head office in Conshohocken, Philadelphia, Mario Giannini, Global CEO of Hamilton Lane, one of the largest private market solutions providers in the world, with nearly $1 trillion under management and supervision. I won't say too much more about them, as I'm sure Mario will do a much better job at that. So Mario, thank you for joining us and welcome to the podcast today.
No, my pleasure. Thank you for having me on.
Start maybe by telling us about yourself and Hamilton Lane, what you do for clients, and maybe even the history of the firm.
Sure. The firm started 31 years ago. I was there at the beginning with just a few people. And we really started as a consulting firm in the private markets, with the idea being private markets were really just starting, primarily private equity at that point, and people needed advice, particularly institutions. And we were very fortunate. I know everyone always talks about the great strategy, how brilliant you are and all that stuff, but we were very fortunate. The market over the last 30 years has really favored private markets. And we've grown and developed along with the private markets. We now do all of the different private equity, private credit, infrastructure, real estate, all of the things that are commonly associated with private markets. And we do it globally. We do it in all of the different subcategories, if you will, venture, pick your category. And as you said, we've grown into one of the largest allocators of private markets capital in the world. We are about 60% US, 40% non-US, offices in 22, 23 places where you'd expect. And I've been CEO, I guess, 20 something years, probably too long. So that's what I've been.
Great. And you've touched on private markets there, and it covers a broad range of categories. Just zoning in on one area of that many people might be familiar with as a concept, private equity. Could you maybe talk a little bit about what private equity is specifically?
Yeah. There's all this mystery and kind of, private equity is this magical, unbelievable thing. Private equity is the same as public equity, just in a private context. You own a piece of a company. You can own part of it. You can own all of it. There are many different forms. You can own a company that makes no money. You can own a company that is big and established. And it is, think about it the same way you think about buying Apple on the public markets. You are buying Apple when it was just formed, Apple when it was, somewhere in the middle of its lifestyle. And that's what private equity is. It's just a private form of equity ownership of a company. And that to me, I think, is very important that people think about it. It's like real estate, private real estate. What is that? It's like owning your home. That's what it is. Only it's not a home. It's some office building in some location somewhere. So I think that the notion of private equity is this weird thing is just because we're not used to it. We're used to public equity, but it's in a private context.
How would it differ from, say, Hamilton Lane, engaging in private equity and owning businesses and buying businesses to, say, another company buying another business to expand? What are the differences there?
The difference between someone who does well and someone who doesn't do as well is there is a skill and a talent to figuring out a few things. I think the most important thing is, what management team are you partnering with? And are they people, again, it's no different. Steve Jobs in the public context, I'll use Apple again. Everyone goes, what a genius CEO or whatever he was. And in the private context, you want to find Steve Jobs of whatever company you're buying. And so that matters a lot, having people that can identify that management skill set. You have to have some perception about what you think the future will look like. Are you in an industry that you think will grow, or a company that will grow within an industry? It's sort of those, I'll call it more strategic factors like that. And some of it, I know we hate to admit it, some of it's just dumb luck. Like you just happen to find a company that did something great and someone went, I think it's even greater. And all of a sudden so I give an example of who would have ever known. There was a company before the pandemic that we were invested in that did leaf guards for, I didn't even know what that was. Like apparently it keeps your gutter from overflowing or whatever. And during the pandemic, everyone fixed up their homes and they couldn't get enough of these things and the company exploded. Was that genius? Who the hell knew? And so I think there is an element of being in the right place at the right time and knowing when to buy it and when to sell it.
That's very sort of modest of you to give an example that where luck was involved. Do you have any examples where Hamilton Lane's actually gone in, bought a business, and sort of done something more than just rode their luck to turn it around?
So we will normally partner with other general partners.
I'm sorry to interrupt. You mean by general partners, other private equity firms?
So like a Blackstone or someone like that, we will partner with in doing that. And so years ago, I think this was like 2010, 2011, after the great financial crisis, we looked at a business that did bottles for beer and things like that. And it was a very poorly run business. It was part of a giant conglomerate, and they were spinning this part of it off. And so that wasn't luck. That was just a lot of work around making sure that you had the right management, that you had the right incentives in place, that you were in the right markets. And so we got most of that right, and it turned out to be a very good deal. So sure, that had nothing to do with luck, other than the conglomerate wanted to get rid of it because they didn't know what to do with it.
Yeah.
But I guess by luck, what I was saying is you need to have a lot of things going, and so as a firm, you need to have people that have the skill set, and then it does help to be in the right place at the right time.
And in terms of performance, and particularly comparing to public markets, how's private equity performed? I guess in your time in the last 10, 15 years?
The last 25 years, last forever. Here's the dirty little secret and why private equity has grown so much. It has outperformed the public markets year in, year out, by sometimes a little, by sometimes an enormous amount, thousands of basis points. And it's done it. I think this is important because it's to your first question of what is private equity? Why has it done it? Everyone goes, well, because it's leverage, well, because it's financial engineering. No, it is a better form of governance. I mean, to me, that is why private equity outperforms and why it will probably continue to outperform. If I'm a public company, I've got a bunch of directors who do not know what I do. They have very little stake in the company. I'm run by a CEO who's motivated largely by cash because that's how we pay them, and we get rid of them very quickly. There's no alignment. Like the shareholders don't even know what we're doing. In a private context, this is why governance is so important. Everybody's on the same page. Everybody owns that company and wants it to do well. There's no misalignment between I'm getting cash, I'm getting stock. It is a better form of governance. And until that changes, either because the public markets become more like the privates or the privates become more regulated and become more like the publics, I don't see that fundamental governance difference changing. And so private will continue to be a better place. It's even so in the United States, what, half of the public companies are gone from 10 years ago. Why? Because no one can stand it anymore. And so until that changes, the private world will be where you want to be.
And there is a perception out there, and maybe that is because of the higher returns, albeit you've touched on why those returns are higher, that private equity is riskier as an investment than, say, the public markets. Is your answer the same?
I would say, so let's divide the private equity world into two pieces. There's the venture capital world, which is what everyone always talks about and gets most of the publicity because everyone, loves those kind of sexy new companies that change the world. That's about 15 or 20% of the private equity universe. That part is far riskier than, I think, the public markets, than any other part of private equity. It just is, because you're dealing with companies that can go out of business overnight. The other 80%, which is where most people are invested in private markets, the buyout, kind of dull buyout companies, is less risky. We've run some numbers that show that the risk of loss in a diversified buyout portfolio is virtually zero, which is not true in the public markets. So I think people have misunderstood risk as liquidity. So there is a liquidity risk because most of these structures don't have instant liquidity that the public markets do. But I think in terms of risk of loss, which is what most people think about when they think of risk, your buyout deals are less risky than the public markets.
And just to touch on more sort of impressions of private equity and why things might harm returns, there is an impression that there's loads of fees built into private equity structures and vehicles, and that tends to erode returns.
It is an outrageously expensive asset class. Outrageous. It is ridiculous. It's ridiculous. No other asset class has these kinds of fees. And here's the battle that will happen, I think, over the next 10 years. Because right now, maybe you're paying ridiculous fees compared to everything else, but you're getting better returns. And so
After
the
fees.
argument, yeah. And so the argument is, on a net basis, I don't care if I'm paying Mario $1 compared to paying the public manager a dime, because I'm getting better returns. That has to continue, or these fees will get driven down very quickly. But I think right now, it is the only way you're going to get the higher returns is to pay these fees. But make no mistake, it's insane. We argue about it all the time with some of the managers we invest with.
And the other issue traditionally with private equity, particularly in retail or wealth markets where they're not big institutions that can be patient with their capital, is the fact that clients generally can't get, or investors can't get their money back for a while, largely because you're investing in private businesses and are not in the public markets. That's changing, and it's changed. Hamilton Lane's been at the forefront of those changes in terms of these evergreen structures. Can you talk a little bit about them and what they are and how they work?
Yeah, I think these evergreen structures are genius. We didn't invent them, so I'm not saying Hamilton Lane's genius. But here's the thing to me: investing in private equity is a pain in the ass. Like it is, it's an asset class that's going to blow your brains out sometimes, because how much am I supposed to commit in order to get this amount invested? I got money coming in, going out. I have no idea what's going on. They report these funky IRR. It is. You just want to go away, all you people. I know you're higher returns, but it's too much work. Like, forget it. So to me, these evergreen structures, they have a liquidity feature, but more importantly, they make it very easy to understand what you're investing in. You invest $1, it goes in as $1 invested on day one, and you're investing in a diversified portfolio immediately. You don't have this kind of weird drawdown blind pool risk, and you don't know what money's going where. So from that perspective, it really does change how you think about investing in private equity. And I think it will affect institutional investors. They will begin to understand the advantages of this. The semi-liquid feature is important in the sense of giving people comfort that it doesn't have to last for 15 years or however long some of these structures last. What I do think is important, though, and that we all need to keep in mind, is that term semi-liquid, because I do worry a little bit that as the high net worth, the private wealth space begins to invest more and more in these, the semi part of that phrase is lost. And everyone goes, it's liquid. Like, it's like a public market. It's not. And maybe at some point it will be, but it's not today. And people need to understand that it's there for liquidity if you really need it, but it's not there for liquidity the way you go, oh, I've changed my mind. Now I'm going to put my whole portfolio in bonds. So as I said, it may develop that way. It also, I think, puts an onus on, I'll use us as managers, to understand how to build that portfolio so that there is some liquidity available, and to have the right group of investors in the product. Because what you don't want is a bunch of investors who are hot money and will, get out and frankly damage the product. So there's responsibility on both sides in terms of these vehicles. I mean, what I always say is, it took institutions 20 years to go from why am I investing in private equity to I know I have to and I will. And the question is how much and what form. It's unrealistic to think that the wealth channel is going to do it in a year. It's going to take time for people to get comfortable with private equity, how it works, how it returns capital. And so this is a process.
Continuing on the theme of demystifying a lot of concepts in private equity, Hamilton Lane in particular, I know, invests across other funds, co-investments, secondaries, directs. Could you sort of help us understand why they're different, what the different opportunities are across these different types of investing in private equity?
Let's start with the biggest part of the market, which is funds. And that's basically the names Blackstone, Apollo, TPG, pick your names. and they raise funds every 3 years, and you commit to those funds, and then they invest over the next 3 years. And you don't know what they're investing in. You kind of know because they tend to invest in similar things from what they've done before. And that's the way the industry grew up. That was the normal way people invested. But as the industry developed, people said, wait a minute, there's got to be other ways to do this. So co-investments became a thing to do, which is essentially, I'll use Blackstone again, just because everyone knows who they are. Blackstone buys a company and says to Hamilton Lane, says to you, I will give you a piece of that alongside me. And they'll do that because they may not want to put in as much money as is required to do the deal. And I love doing it because generally I'm getting it for no fees. And so it's a free alongside a reputable and very good general partner. That has become a very big part of the market today. And so, for example, in our Evergreen vehicle, our semi-liquid fund, co-investments are a huge part of that. The other thing that has developed in the markets are secondaries that you referred to. Huge development in the market, because what that basically, remember I just talked about the funds. Let's say I'm a limited partner in those funds. I've made a commitment and I don't want it anymore. I've had it for 6 or 7 years. There's still a bunch of companies. I sell it to Hamilton Lane, usually at a discount. And now I'm no longer a limited partner, but Hamilton Lane is. And those are very interesting transactions because you can price the risk. You know the company, you can figure out when you think it's going to get sold and what you think it'll be worth. And that is I think, increasingly important and significant part of the market.
So those would be called secondaries.
Secondaries, yep.
Yeah, and why would, I mean, I suppose listening to that, you're thinking, why would in the first example of co-investments where you're going in alongside a private equity fund and they don't want to take the whole position, if they like the company, why wouldn't they take the whole position? And linked to that, why are they selling funds at a discount on portfolio companies that they like? I mean, what do they know that the buyer does not know?
Well, there are a couple of things. On the co-investment side, they'll sell it or they'll give us, Hamilton Lane, a piece of it for a couple of reasons. One is they do have limitations on how much they can put in individual companies, either imposed by the agreement or that they don't. They don't want to put more than 10% of their fund in any company. This deal will require 15%. They want to sell that 5% to people like us. Second, they want to bluntly curry favor with us because they know we're going to invest in their fund. And it's a way to create a partnership and a relationship that is beneficial to both. On the secondary piece, why do you sell at a discount? Part of the reason it's happening more and more is portfolio rebalancing. Let's say I have a portfolio of 50 partnerships, 50 general partners, and that's too many. I only want 40. Or I like 10 different ones and I want to have 50 total. I will sell 10 of my existing relationships. And I'll sell them at a discount because I probably made some money on them already. And I'm fine with taking a discount. And that's how the market works. The discount will vary. So today, for example, in today's market, you can buy venture portfolios composed of venture companies at 50% discount because people have no idea what they're worth. You can't do that in the buyout world. Like right now, you're probably paying 10% discount, but it'll vary. In the height of the bull market, there was really no discount because everyone thought or felt that the companies were going to continue to grow. And in the height of the depth of the bear market, you could get 25% discount. It just really depends on market conditions.
And you've touched on valuations there. It's a big topic in private markets at the moment in terms of valuations. Are they fair? Can you explain a little bit about how valuations work and why you believe, particularly in more evergreen structures as well, but maybe across private equity, why you do think that valuations are sort of where they should be or not?
No, look, again, I'll divide the world into two pieces, the venture capital world and the buyout world. In the venture capital world, I personally believe that valuations are still too high. It is very difficult to value a venture-oriented company that isn't making any money. It's look, even in the public markets. Look at Tesla. Like a few years ago, Tesla was going to be the most valuable company in the history of the world, and now people are wondering if it's going to be okay. And so in the venture world, which again is what gets all the publicity, there's a huge amount of controversy over, and in Australia. So I've said this, that if I ever meet the owners of Canva, I will scream at them, because Canva, every time I'm in Australia, people look at me and go, valuations are bogus. Canva. And I go, I get it. I get that Canva has different valuations, but it is a company that is so hard to value. And so let's take that 20% out. On the 80% that is buyout, which is where the bulk of the valuation in most portfolios sits, the valuations have been very, very accurate, I think. They've not been over or undervalued. In our own portfolios, in the semi-liquid product, we have an outside firm that revalues them every month. It's not, Mario in his garage going, it seems like 10 is the right price here. It's a subsidiary of S&P that revalues the portfolio. And what we have found is it's generally been pretty accurate around the valuations. Now, the real reason that they didn't go down as much as the public markets went down, which is when everyone said it can't be right, is earnings were growing 2 or 3 times what they were in the public markets. So even if the multiple was coming down, the earnings were doing so well that the valuations were holding up. So I don't buy this notion that valuations in the private markets are inaccurate, other than in the venture world, where I suspect there's probably still more pain to be taken.
The global market outlook, the global economic outlook, interest rates have obviously gone up considerably. Wherever you think they may land, they are likely to be structurally higher than we've seen over the last few years at least. How do you think that might affect private equity, considering that there's leverage built into the buyout world in terms of borrowing to buy companies? How does that affect potential returns going forward? Will they be different to historical as a result of a structurally higher interest rate environment? And is that what you think will happen?
I personally believe rates are coming down, and just as we were surprised at how fast they went up, I suspect we'll be surprised at how fast they come down. But I don't believe we're going back to zero. So let me talk about that for a minute, because I think it is important. What we always hear is returns in private equity have to come down because rates were at zero and now they're not. What zero rates did to private equity returns is it juiced them. It's like returns on steroids. That's what happened. And that doesn't mean that the return. So if you could see me, you could see I don't take steroids. Like the opposite, whatever the opposite of steroids is what I apparently take. But if I took steroids, I could lift, I don't know, 200 kilos. I don't really even know. Probably not, right? 100 kilos, whatever I could lift. But if I don't take steroids, I can still lift 50 kilos, against half of that or whatever. And so that to me is what private equity has done. The fact that private equity got outsized returns during a zero interest rate environment does not mean that those returns are going away and will be zero in a higher interest rate environment. I suspect they will be lower, just as I suspect public market returns will be lower. So I look at that and go, in a 4 to 5% interest rate environment, private equity will be fine. If you tell me it's going to 10, 11, 12, we all are going to have some real challenges around financing deals, around what cash flows look like. But at these levels, I'm still not seeing a whole lot of stress in portfolio companies. You can still get deals financed. It's more expensive. So I think, your targets are going to be a little different in terms of what you're willing to pay and what you think your return end of day will look like. But again, relative to the public markets, I'd much rather be in privates.
So what is the Hamilton Lane economic outlook, and specifically where do you feel the opportunities might be in private equity? Maybe we can finish on specific sectors or concepts that you're looking at out there.
Sure. I mean, I think that in this environment, if we look broadly at private markets, our core economic outlook is that the U.S. economy will slow down in 24. Inflation will no longer be the topic of conversation anywhere in the world. It just won't. And I think even the U.S. Fed came out with a study last year that said that 2/3 of inflation was driven by supply chain issues. Those are all gone, basically. So I suspect that you will see inflation head down into reasonable areas here and in Europe. Rates will come down. The economies will slow, which isn't a terrible environment. It's not great, but it's not terrible. And so I think in that kind of environment, the places you still need to be looking at areas that have growth potential. I don't think technology and healthcare are done as themes for us going forward for anybody. In a lower growth environment around the world, you're going to have to find places that are growing outsized relative to core economic growth. And those themes will not be different from what they were in 17, 18, 19. Technological shifts, healthcare shifts, the underlying demand behind those will continue. I do think you still need to have a good private credit allocation. I think that remains important just because interest rates are higher and almost as a hedge. But I think the private equity environment will continue to favor a more growth oriented portfolio tilt.
Great. Mario, we're just out of time, but thank you very much for joining us today. It's been a real honor to talk to you, and that's incredibly enlightening to hear your views on private equity. And hope you can join us again in the future.
I'd love to, and thank you for the opportunity.
Thank you.